We're going to move into our next presentation here. Um, Jennifer, are you on with us?
I am. Hi.
Hi, happy holidays,
Likewise.
Camilo. Happy holidays. Thank you both for taking the time today to do a live Q&A and a fireside chat. Um, this one's going to hopefully be virtual. I wish I had a little fireplace for you both. Um, how are you doing today?
Great.
Great, Michael. Thank you for having us.
No, thank you for doing this. So, with that said, Jennifer, if you don't mind just taking a moment and just discussing what the format is, because it's a little bit different than what we normally have done, that would be great.
Sure. Well, first of all, good afternoon, everyone. Thank you for the opportunity. I'm principal of BKR Media. It's a full-service PR firm with an emphasis on real estate here in South Florida. And I've actually had the pleasure of working with our speaker today, Camilo Nino, for several years now. And I know firsthand just how seasoned he is in the commercial real estate realm, and can offer various perspectives on the industry, both as a lender, as a developer, as an owner. So hopefully, it'll be very informative for everyone. We've really tried to tailor today's Q&A to target the questions that we think that you probably have. And, this year has been incredibly enigmatic for all of us. So, we really hope that it's just informative, and we've kind of shifted the format a little bit to, instead of a PowerPoint, we've really tried to make it a little bit more engaging as a dialogue. So it's going to be a live Q&A. I encourage you to submit your questions. I'll try to include as many of them as I can within the time frame that's been allocated, but we're really going to try to keep this concise and to the point, and again, as informative as we can. And Camilo Nino, our speaker today, is CEO and founder of LinkVest Capital. It's a vertically integrated real estate firm that offers a co-investment platform for family offices and private investors. He brings over 22 years of experience as an investment advisor, real estate investor, and private lender. So again, that's where those various viewpoints can come in, perspectives. LinkVest Capital has a variety of entities. Its private lending arm, LV Lending, currently services a portfolio of over $240 million. And to date, the LV Lending has overseen nearly 500 transactions for over $450 million in both Florida and Georgia. And then at LinkVest Properties, Camilo's real estate investment and management firm, they acquire commercial real estate assets throughout the Southeast region as well. And they currently oversee a large portfolio of projects, including single tenant properties, shopping centers, and industrial assets, again, in Florida and Georgia. And then through LV Development, Camilo and his firm established partnerships with prominent developers and their projects. So in the last 2 years, LV Development has invested in 7 multifamily projects, and they have over 1,600 residential units slated for delivery between now and 2024. So today's discussion is really going to focus on, what those key investment players are, who those key investment players are, the types of investment opportunities that exist, what's fueling the deals, short and long-term trajectories. And again, we're going to leave some room for Q&A, maybe just touch upon some of the high-profile transactions that have taken place. And so any questions so far?
Thank you for the introduction, Jennifer. You make me feel really important.
You are important, Camilo.
Thanks.
All right, so let's get started. So as someone with significant financing, acquisition, and development experience, you've really worked with a lot of high-profile developers, investors, and property owners. So you kind of have your finger on the pulse throughout the entire region, Florida, Georgia, Southeast. What asset classes do you believe have been most positively and negatively impacted in commercial real estate here throughout this crazy year?
Well, first of all, we are more than lenders or more than developers, really. We are real estate investors, and all the comments and the lessons and the ideas that I will mention is from that perspective. Basically, sharing with you guys and with the audience what we found this year, which was obviously really atypical and difficult to understand. And also how is everything going for us and how we have seen the market perform. I think in the real estate market, every market, submarket, every asset class, and inside each asset class, depending on the location, you can have a different story. So I do have a bias, and I want to start with that. I can share with you guys how it's going for us and what do we see for the next 12 to 24 months as opportunities or risks in the industry. We have here today and for the last couple of months, one of the best assets that is performing, of course, is industrial, which we do believe that the industrial market is pretty strong. And because of the pandemic, they even got a more important role in the real estate market as an asset class. Multifamily, we are strong believers in multifamily, at least in Florida or South Florida, because at the end of the day, multifamily depends on demographics, and the demographics here are really good. So even though we have a lot of inventory and a lot of units coming into the market and in the multifamily market, we do believe that the demographics support that, and that's why we are lending and co-investing in that kind of assets. And also something that is actually a result of the pandemic is the single family homes. The single family homes are doing pretty well in South Florida. A lot of demand from people moving to Florida. I think that the COVID and the pandemic push or increase the speed of a trend that was happening before, like relocating people from California or New York or other high income tax states, but also because of the weather, because of the density of the cities, which is lower here than in other places, a lot of people start moving here, and they tend to increase the demand on single family homes, either for rent or to buy those kind of assets. So I think those three assets have been positively impact. Negatively impact office. I do not believe that office are going to disappear at all, but it's a market that is under pressure. The remote working, I think, is proving that it can work for some of the roles at the offices. There is going to be a reduced office space demand. Even the big corporations can understood that they can relocate some people, and they don't need everybody in a headquarters, that they can have either satellite offices in different places or people working from different places for some roles. So office, definitely. We don't do offices, and we don't invest in offices, and we don't lend in offices. So we haven't been impacted on that, but we saw a negatively impact during this year. Retail, again, retail is not new that the retail is being impacted. And when I mean retail, there is a lot of retail that is performing pretty well, but there is a lot of retail that the big malls and the big boxes that have been negatively impacted, not just because of the pandemic. This started a couple of years ago, but the impact is worse because of the pandemic. Condominiums, at the same time that the single family homes is getting a lot of traction and a lot of demand, we see that condominiums, people is moving out of condominiums, and it's getting more difficult to sell condominiums. So the prices either are staying at the same level or going down, and in most of the markets, not all of them. And of course, hospitality, everything that is related to tourism, cruises, hotels, restaurants, bars, they have a really hard time this year. I do believe that this is going to come back, hopefully in the next 12 to 24 months, but it was really negatively impacted during this year.
And so the deals that are actually being made right now, what do you think is fueling those deals? At least here.
I can give you two answers, one as lender and the other one as a equity investor in real estate, either projects or properties. As a lender, we saw the banks and a lot of debt funds at the beginning of the pandemic really having a difficult time to do new deals, either because they didn't want to increase exposure, or it was difficult to measure the risk, or they, in the debt funds arena, they have leverage, so they have to deleverage their portfolio, etc. So between March and June, July, it was a difficult time. So for us as the lending platform, actually it was an opportunity because we start getting access to really good properties, good and experienced developers or real estate investors that under normal circumstances, they will have access to banks or institutional money. But because of the pandemic and the difficulty of getting those loans, they have to come to a private lender or a bridge lender. And that allow us to start the relationship. And we are much more, we are only focused on the relationship more than the transaction. So when we start the relationship, that opened the door to either do more than one transaction with those investors, or end up being partners in some of their investments. So in the lending side, I think banks reduce their exposure. Some of the debt funds at the beginning reduced exposure by the second part of the year. They came back aggressively. A lot of private money is doing lending now. There is a lot of competition. Everybody with liquidity, because of the low interest rate environment, they are looking to do high yield loans. So that the private money funded a lot of deals here in South Florida, and also money coming from California and New York. A lot of those big funds try to reduce the exposure in those markets, and actually start to being interested in Florida. For example, we've been approached for a couple of big funds that want to do co-lending, that they don't have the experience or the people here in Florida, but they want us or lenders like us to be their boots on the ground, to bring the connections, to bring the deals, to bring the underwriting capabilities, to bring the servicing capabilities, because they have the money and they need to put the money to work, but they want to reduce their exposure in places like California and New York. So that trend, I think, is been supporting the real estate market in South Florida, and is bringing a lot of new capital to be deployed either as a lending, as loans, or as equity investors.
And what about incentives?
What about what? Sorry?
Incentives?
When I imagine you are talking about for example, the multifamily market. We are investors in multifamily, and what is happening right now is that everybody is offering 1 or 2 months incentives to bring tenants into their buildings, and that is becoming like the benchmark. So that also creates a distortion into the market. But if everybody is offering an incentive like 1 or 2 months free rent, you need to start doing the same to bring the tenants into your buildings. So that is changing the market. I agree. But anyway, the demographics, I think, support the real estate market and the equity investments in multifamily products specifically, as new people is coming to Florida every day. There is a lot of reports that say between over 1,000 people coming to Florida, and a big part of that is coming to South Florida.
Mm-hmm. And I mean, you work with both national and international investors all day long. So, how do you think their mindset has shifted, and how is it different for those markets?
We are investors ourselves, so we are real estate investors. So we understand, and we've been analyzing what has been working and what is not working, because we have some impact in some of the investments. So I think some of the lessons that every investors and we as investors remember during this crisis is the importance of diversification. So we have a lot of Latin American clients and investors, and they understood, or they know that, but they knew that since the beginning, but now they understand that it's more important than ever to have a diversification and have money out of their countries, because things like this can happen and eventually will happen again. Hopefully not as bad as this, but some crisis like this one will happen again. And having diversification in a different country, in a different currency, in a market like this one that is much deeper and has the possibility and the capabilities of giving incentives and a lot of money to the public and support from the government, the possibility of protecting your investments and getting the growth back into the economy are much higher than in other countries like in Latin America, where we don't have those capabilities. Also, the investor mindset is that they understood that the low interest rate environment is here to stay. So they are looking, and everybody is chasing for yield. So that's why I think there is a lot of money coming into the debt or the private debt arena, because they see that as an opportunity to get a high yield product with relatively low risk, because you don't get any money at all in bonds or just in CDs at your bank. So chasing for yield and the low interest rate environment is also an investor mindset or an investor change. Also, there is too much liquidity, and I think there is too much liquidity waiting for opportunities, waiting for the distress opportunities that at least we haven't seen them, not in the volume and in the discount that we were waiting. We don't know if they're going to come next year. I think there are going to be some price dislocation and some opportunities, but maybe when there is so much liquidity waiting for the great distress opportunity deal, it never comes, because every time that there is a deal or there is a discount in an asset, the owner receives 2-3 offers over asking price, really aggressive terms to be able to get the opportunity. So it's getting difficult to get really good deals, and that's why, as I told you, I think that's why the private lending arena is getting really crowded and competitive, because there is a lot of capital wanting to get a yield, a good return, and they see the private loans as a good vehicle to get that.
So we do have a question that I can bring in right now. You had mentioned that Miami condos are declining and struggling, which I am seeing and agree. Do you think that there is a strategy to go after those in the coming years? How far do you think Miami condos might fall in price? It seems like every new building has multiple years of inventory and dramatic vacancies.
Great question. Condos depends again on the submarket, but downtown, Brickell, this specific market, there is a lot of inventory. We as lenders, we receive maybe 4 or 5 proposals from developers that still have 40, 50, 80, 100 units that they haven't sold in their condos, and that they don't want to reduce the price that much. So they offer us to do like an inventory loan on the whole 100 units, which we didn't do because we are not really bullish on the condominiums for now. But that tells you that the developers are having a really hard time selling the condos at the price that they were expecting. And that means the demand is not there, or at least not at the prices that they think. And also this COVID thing with the risk of getting into an elevator and sharing a pool, or having to be in your condo for a long time and cannot go out. That's why it also help the single family homes and create a bad environment and a difficult environment for the condominiums. Having said that, I'm a strong believer that this market will come back. I don't know, regarding the question, I don't know what percentage will the price decrease. I think nobody knows. That depends on any case, because if the owner needs to sell, they really have to do a big discount, 15, 20, 25% discount to sell the condo. But what we have seen is that there is a lot of people with a lot of money, a lot of equity invested into those condos, so they don't need to sell. And if you don't need to sell, you don't need to give a discount. If you don't need to give a discount, the prices stay at the same level that they are now. So that's why it's difficult to tell what is going to be the reduction in prices on the condos, but I'm pretty sure there will be opportunities in that specific asset class.
And there could be some rollover. I mean, there's limited inventory with single family homes, which, you know, they can only go up so high before people start looking at the condos, right?
It will come back.
Right.
If there is more people coming, and if it's real that 1,000 people per day is coming to Florida, and a big part to that is coming to South Florida, and a lot of companies relocating to Florida, which is great news, but that brings more people. They have to live somewhere.
Right.
And there is the single family homes inventory, as you said, is limited.
Right. So you've been very active actually throughout this whole year, believe it or not. Can you share with us some of your recent transactions, and in particularly some of the challenges you've faced and how you've overcome them, and what you've also observed from third parties as well?
Sure. This year validates something that we really believe in our company, and it's all about the people. It's all about the long-term partnerships. And that's why we've been active this year, because we have done transactions mostly with people that we already have a relationship, and that we've been able to be flexible and support and understand their plans, and being able to provide financing or mezz loans or equity investments for the new projects. So that's why we feel safer, and it's all about the people and the long-term partnership, and the people that you can trust, and the people that has the experience to invest even in these difficult times. So, for example, we finance the acquisition of a distressed hotel property in Hialeah. Really, we closed in 2 weeks, over $11 million transaction. Of course, we did it in 11 million because we know the market in Hialeah, but mainly because we know the sponsor, and we know their capabilities, and we trust them. And we have done transactions with them, and we've been partners with them in multifamily projects. So that make it easy to take the decision and be able to close in 2 weeks. And with this, most of the people can close in 2 weeks. And for sure, none of the banks can close in 2 weeks an $11 million transaction in a distressed asset. And for example, in those kind of deals, we do a 6-9 month bridge loan, and then we can convert either to equity or to a mezz loan, because of course the construction loans are, as we mentioned, are getting really difficult to get, and if the banks used to lend you 75% loan to cost, and they went down to 65 or 60 now, there is a gap that needs to be filled, and we've been doing with those people that we already know. We've been doing second mortgages or mezz equity, mezz loans or pref equity to fill that gap, and that's what we are doing in that specific transaction. So it helps that we know the people, that we trust the sponsor, but also it helps that our platform is flexible enough to provide a first mortgage transaction, and then when they get the permits and the construction loan 6-9 months later, we can move into the pref equity or mezz loan, and sometimes have the option to convert into equity into the deals. Also, another kind of deal that we did in Orlando, in Lake Nona, a really good area in Orlando that has been growing. It doesn't matter the COVID. It's the medical city of Orlando, so actually it's being pretty successful. The developer, the master developer of the city, during these last 12 months, to continue the growth and development of Lake Nona, the Lake Nona market. We start a couple of years ago with a loan to acquire the property and entitle the property. Last year, we became partially partners in the proposed development of the multifamily project. And this year, even with the difficulties of the COVID situation, we got a hot loan with the government, was sponsored by the government, for 85% loan to cost of the construction of the project. So we moved from being the lender to being partner to being co-developer with the developer, and getting a pretty good finance a pretty good finance from the government. Took much longer than expected. Took us almost 12 months, but we got really good terms, and now we are moving into the construction phase of that project to develop a multifamily project in that market that is growing a lot also.
We actually have another question. With respect to the hotel transaction, the option to convert to mezz debt equity at LV, is that type of relationship typically laid out prior to funding of the initial loan?
We have done both. We have negotiated the right of first offer to convert into equity in some of the deals, or after getting to know the developer and develop the relationship with them and trust them, we offer to convert part or all of our loan into an equity transaction. But again, it's all about the chemistry and the experience and the trust that we can develop in the relationship that brings us to become not only lenders, but financial partners into the projects.
And going back to challenges, because you kind of talked about the types of transactions you've done, but you've also developed, or partnered with developers. So what kind of challenges did you see there from the other side?
Getting the construction loans is taking forever. We had one project here in Miami with a really good developer that we were approved by a bank back in February. The COVID came, of course, and it took the construction loan back to the investment committee, but the bank took 6 months, and at the end of the day, they say no after 6 months of reviewing the deal. So we stopped the project basically for 6 months. Then we have to go to another lender and an insurance company to do a mess. Finally, we end up closing, but it took us 6 months, and we lost 6 months because of the difficulties of getting a construction loan with a bank. That's one specific and real case. And also the case that I just mentioned in Lake Nona, it took us a year to close. Really good conditions and a great loan, but took us a year. So we have to wait a year just to get the construction loan. So for us, in the partnering with developers, because we are not developers, we partner with the developer, and we provide a big part of the equity for the project. Our main challenges have been the construction lending, being able to get a construction loan, and also the cities were really slow in all the inspection process, permit process, etc., because they have to learn to work remotely. And you can imagine that if normally, under normal circumstances, it takes time to get a permit or an approval. With the COVID situation and the remote working, it became a challenge to get those approvals and those permits. But I think that's getting better, and at least for us, it's working. We are only doing that in multifamily. So at least for multifamily projects, I think they're still considered low risk for most of the banks. So they start lending again. I would say July, August this year.
So you mentioned that you work mostly with people that you have, or companies that you have relationships with. What advice do you have for people that are looking to create relationships with you, who maybe haven't worked with you before but are eager to kind of get started?
I will give you like my advice or the lessons, not advice, lessons, what we think is working, and what any investor should consider before investing in this kind of real estate projects, or either working with us. I think that maybe the first point that you need to understand is the risk, and what is the worst case scenario of any investment that you are planning to do. And I do believe that a lot of investors don't understand that until it's too late, or they're already invested into the deal. So I will say that's one of my first lessons that I would like to share, is understanding the risk, the worst case scenario. And if you can accept, and if you are okay with the worst case scenario, then you are ready to do that investment. If you don't like the worst case scenario, and cannot accept the risk that that worst case scenario could bring, maybe you should consider a different investment. Second lesson, this is not new, this is for everybody, but this crisis reminds us of this. Cash is king. It's all about liquidity. And for us in real estate, the main risk that we see as investors is liquidity. If we need the money back at some moment during a crisis or a period like like this year with the COVID situation, then you can have a big loss or you can have a big problem. If you can wait, if you have the staying power, if your capital and the sources of your capital, not only yours, but your investors, they can wait and they are paid. You have patient capital that can wait. Most of the times in real estate investments, you will be okay. So understanding the liquidity and being comfortable with the illiquidity risks that the investments that the real estate investment brings, I think is a must on any investment that you do in real estate. Third, back to basics. I think real estate is all about, at the end of the day, demographics. If there is people that needs to live in a market and people coming to a market and people with money that can buy an apartment or a house, or than people with money that will go because there is too much traffic, a lot of people living around there, so the retail can work. I think you have to understand the demographics of every deal that you do. That's why for us it's difficult to go out of our markets, because at least we can understand and feel safer in Florida and Atlanta area. That those are the only markets that we do for now, and that's been mainly our main restriction. Understanding the market, getting to know the people, getting to know the laws of the specific markets and the demographics of the specific markets, I think is a must before doing any kind of investments. And it takes time to understand that, and until you have that, either you partner with a group that understands that, or you take your time to do your homework. Those are maybe the three most important lessons. And of course, as a famous investor says, Warren Buffett, I do believe this: never bet against the US economy. I think that this country has a great capability of restructuring, reinventing itself, and you cannot be short on the US for a long time.
And what do you think about like short and long-term trajectory in South Florida? You know, what
Jennifer, I apologize to jump in here. We're 2 minutes over for the next panel.
Oh, that went fast. Okay.
I know. I'm sorry to cut you off, and I'm listening to everything you said, and Camilo, I couldn't agree more. You shouldn't bet against the U.S. economy, right?
I agree.
It's a sure way to go broke.
Well, I hope we address, some of your questions, and I'm sorry we didn't have time for a huge Q&A, but thank you so much, for everyone that listened in, and I hope you got something out of it. We certainly hope to continue growing and doing business together through this amazing platform, through, all the wonderful networking opportunities that Flya provides. We're really hopeful for a positive 2021. And I know on behalf of Camilo and I, we wish you all a happy, healthy, prosperous year ahead. So thanks again.
Thanks, everybody.
Happy,
and Michael,
happy
thank
holidays.
you very much.
Yes.
Michael,
Happy
thank you very much for organizing all these events. They've been really,
Camilo,
really interesting and useful.
We're going to be doing it 10 times next year, so get ready to speak often. And additionally, congratulations on funding these loans and doing what Linkvest Capital does best. So
thank you very much.
I appreciate you. Thank you.
Thank you.
Bye, Jennifer.
Bye. Take care.